Welcome to the Business Owner's Guide to Reading and Understanding Financial Statements, based on the work of Lita Epstein. In this audiobook, you'll discover how to read the numbers behind your business, turn reports into real-world decisions, and use budgeting, forecasting, and cash flow monitoring to stay in control instead of reacting to surprises. Whether you're running a small startup or a growing company, you'll learn how to use income statements, balance sheets, and cash flow statements, as well as customized internal reports to manage profits, costs, and growth with confidence. If you find this audiobook useful, please take a moment to follow or subscribe so you don't miss future content. Share it with other business owners or colleagues who could benefit from stronger financial skills, and leave a rating or review so more people can discover it. Your support, subscribing, sharing, and liking helps this material reach the business community that needs it most. Introduction. In the Business Owner's Guide to Reading and Understanding Financial Statements, Lita Epstein offers a practical roadmap to help business owners truly understand what lies behind their numbers. She explains what goes into financial reporting, what each of the main financial statements shows, and how to use both external and internal reports to make smarter decisions and avoid common financial pitfalls. Part 1. Using external reports to gauge a company's health and competitive status. Financial reporting is the process of gathering key figures that summarize what is happening financially inside a business. These figures create a financial picture that covers a company's assets, liabilities, equity, sales, costs and expenses, profit or loss, and cash flow. Three primary financial statements play a central role in assessing a company's financial health: the income statement, the balance sheet, and the statement of cash flows. A business can fail for many reasons, but Epstein highlights several causes that are directly tied to a weak understanding of financial statements. She emphasizes that the key to success is learning to look beyond the surface of the numbers and working with an accountant to develop customized internal reports that give a more accurate view of the company's financial health. By examining details such as customer payment behavior, inventory turnover, and cost control, a business owner can spot problems early and make quick course corrections to stay profitable. Key concepts. First, an income statement might show a profit, yet that profit alone does not necessarily represent the true financial condition of the company, because it does not reveal what the company owns, what it owes, or how much equity the owners have. Second, to understand what a business owns and what it owes, you must examine the balance sheet. Third, the statement of cash flows provides insight into how much cash has actually flowed into and out of the business over a given period. Customizing internal reporting. Business owners are not limited in the kinds of internal reports they can create to run their companies effectively. Internal reports can show which products generate profits and which generate losses, identify which areas of the company deserve more resources to encourage growth, and help determine appropriate staffing and inventory levels so customer demand can be met without tying up excess cash. Who uses financial statements? The actual owners of business are not the only people who rely on key financial statements. Many different stakeholders depend on the information contained in these reports, whether or not the company's financials are publicly available. Most small businesses are privately held, yet they still must provide financial information to an important group that may include managers, investors, suppliers, vendors, and the financial institutions they work with. Financial statements only have to be made public when a company sells its shares on a public market. At that point, the business is considered a public company and must file a series of reports either with the Securities and Exchange Commission or with the state in which it operates, depending largely on how many investors it has. Budgeting for results. Preparing a budget on a regular schedule, monthly, or even weekly allows a business owner to closely track how the company is performing. It also enables the owner to react quickly to cash flow pressures, shifts in the economy, and sudden, unexpected growth. Methods of accounting. Companies generally choose between two main accounting methods to track their finances, and the key difference is how they record cash coming in and going out. Cash basis accounting suits smaller, unincorporated businesses and most sole proprietors. Under this method, expenses are recorded when cash is actually paid, and revenue is recorded when the money is physically received. The benefit is that it reflects the actual cash available and does not require a large accounting staff. But the drawback is that it does not carefully match revenues and expenses month by month, which can distort performance trends. As a company grows, it usually becomes necessary to switch to the accrual method of accounting. In this approach, revenue is recorded when the transaction takes place, not when cash is collected, and expenses are recorded when they are incurred. The benefit is that revenues and expenses are better matched, giving a clearer picture of the company's real financial condition. But this method often requires more staff and introduces more complexity, which can create opportunities for mistakes or manipulation. The importance of cash. Ultimately, cash is the lifeblood of any business. Internal reports that track cash flow are essential for understanding a company's true financial position. These reports help with budgeting, so owners can anticipate cash shortfalls, plan inventory to support expected revenue, and monitor customer collections to keep cash coming in the door. The balance sheet. One of the most important financial statements for any business owner is the balance sheet. A balance sheet shows the company's position at a specific point in time, often at the end of a month, quarter, or year. It tells the owner what the business owns, what it owes, and how much equity belongs to the owners. Assets on the balance sheet can cover a wide range of items, but are usually divided into current assets and long-term assets. Current assets are those that can quickly be converted to cash and are likely to be used to pay bills in the coming year. These typically include cash on hand, accounts receivable, and inventory. Long-term assets are those held for more than a year and are not easily converted to cash. They include land and buildings, which are depreciated over time, shown through an accumulated depreciation line on the balance sheet, as well as machinery and equipment, which are also depreciated usually over a shorter period. In addition to current and long-term assets, the balance sheet may include intangible assets, such as patents, copyrights, trademarks, and goodwill. Liabilities on a balance sheet are also grouped into current and long-term categories. Current liabilities are debts the company must pay within the next 12 months, including short-term borrowing, such as credit cards and lines of credit, current portions of long-term debt, accounts payable owed to vendors and contractors, and accrued liabilities like payroll taxes or sales taxes. Long-term liabilities are obligations due in more than 1 year, such as mortgages and loans on machinery and equipment. The final section of the balance sheet shows the value that effectively belongs to the owners. This is the equity section. At the end of each year, a company can reinvest its profits back into the business or distribute them as dividends to owners. Profits that are retained rather than paid out accumulate in an account called retained earnings, and the retained earnings line shows how much profit has been reinvested in the company since it began. The income statement. The second key financial statement that every business owner needs to understand is the income statement. The income statement answers a simple but critical question. Did the company make a profit or incur a loss over a specific period? It is typically broken into 4 main parts. First is net sales or revenues, which represent the total money collected from customers, minus any discounts granted and returns accepted. Second is the cost of goods sold, which shows what it cost the company to purchase or produce the goods or services it sold. Third is expenses, which capture the operating costs for the period, such as advertising, administrative expenses, rent, salaries, and similar items. Finally, net income or net loss, the bottom line, reveals whether the business earned a profit or suffered a loss. Why budgeting is important. Every business should prepare a realistic annual budget and then use that budget to create a budgeted income statement for ongoing tracking. Reviewing the budgeted income statement weekly, monthly, or quarterly makes it possible to spot trends early, trends that could significantly affect year-end results. In companies that are not sole proprietorships or simple partnerships, owners should not be the only ones involved in budgeting. When there are key managers who carry responsibility for achieving targets, it is best to form a budget committee and allow each manager to develop the budget for their own area. All budgets begin with a sales forecast. Companies estimate whether sales will increase or decrease in the next 12 months based on several factors, including a review of past sales by product line to spot trends and identify items that might need to be discontinued. This review also supports pricing decisions, raising prices on strong sellers and cutting prices to clear slow-moving items. Market research is another essential input, as it provides insights on potential demand and competitive conditions in the industry. When preparing an annual budget, it is also important to factor in general economic conditions and industry-specific forecasts, and then adjust the sales projections accordingly. The statement of cash flows. Managing cash is challenging because without proper internal controls, cash can disappear quickly. The financial statement that shows whether a company has enough cash to pay its bills is the statement of cash flows. This statement focuses on cash receipts, cash payments, and changes in cash balances after taking into account the costs of running the business. The statement of cash flows is divided into three main sections: operating activities, investing activities, and financing activities. Operating activities include items such as depreciation expenses, changes in inventory, accounts receivable, and accounts payable, reflecting the cash impact of day-to-day business operations. Investing activities involve cash used to buy or improve long-term assets like buildings and major equipment, or to acquire other businesses, as well as cash received from selling assets or marketable securities. Financing activities capture cash flows related to obtaining or repaying capital, such as issuing stock, paying dividends, taking on new loans, or paying down existing debt. Part 2. Using internal reporting to manage profits and costs. Partnering with an accountant to design tailored internal reports is one of the most effective ways for business owners to understand their company's true financial status and anticipate future problems. There is virtually no limit to the internal reports that can be created, and these reports become crucial tools when making major decisions. They help guide budgeting, inventory management, customer collections, discount and pricing strategies, and control over manufacturing costs. Managing inventory. Managing inventory is critical because inventory is often a company's primary source of future revenue. For businesses that buy goods for resale, such as retailers and supermarkets, inventory management largely involves determining what sells well and what is not, then adjusting purchasing, pricing, and freight costs accordingly. To monitor inventory trends, a business can use either periodic or perpetual inventory methods, or a combination of both. Periodic inventory requires physical counts at regular intervals, which can be time-consuming but ultimately yield very accurate numbers. Perpetual inventory uses a computerized system to adjust inventory levels automatically after each sale, a necessity for high-volume operations. Even companies with perpetual systems often schedule periodic physical counts to account for spoilage, theft, or other discrepancies. Calculating the value of inventory is important for projecting potential revenue, but the approach differs depending on whether the business is retail or manufacturing. It is also important to monitor how quickly inventory turns over and is converted into cash. There are 5 common methods for determining inventory cost, each with its own implications. Inventory valuation methods. The first is last in, first out, or LIFO, used in businesses where the age of inventory does not matter, and the assumption is that the last items placed into inventory are the first ones sold. The second is first in, first out, or FIFO, used when spoilage is a concern. It assumes that the first items placed into inventory are the first items sold, as in the case of perishable goods in a grocery store. The third method is average costing, which averages the cost of beginning inventory with the cost of inventory purchased during the period to arrive at one average cost per unit. This provides a straightforward way to monitor overall cost trends. The fourth method is specific identification, in which the cost of inventory is calculated by tracking the actual cost of each individual item. This method is best for high-value, customizable goods such as automobiles. The fifth method is called lower of cost or market. Here, inventory value is based on whichever is lower, the actual cost or the current market value. This approach is common in businesses where inventory values fluctuate rapidly, such as dealers in precious metals, commodities, or publicly traded securities. Inventory in manufacturing. Manufacturing businesses face more complexity when valuing inventory because they must consider both fixed and variable costs and adjust them to achieve their profit goals. Fixed costs are those that must be paid regardless of output, such as direct labor tied to keeping the plant running and the costs of operating facilities and offices. Variable costs are more flexible and include items like raw materials and additional labor that vary with production levels. When a manufacturing company sets revenue targets, it must analyze key accounts from the previous 12 months, including raw material purchases, labor costs, and manufacturing overhead. After all costs and expenses are captured, the final inventory value reflects the combined worth of raw materials on hand, finished goods, and goods still in process. Discounts and special pricing. If inventory is not selling fast enough to support healthy cash flow, discounts and special pricing can be useful tools to stimulate demand. Both approaches involve reducing revenue per unit to increase total sales, but each works differently and should be tracked separately. Discounts are publicly advertised price reductions aimed at creating a short-term surge in sales, either to generate quick cash or to clear slow-moving stock. Special pricing is a longer-term, privately negotiated arrangement with a large customer, offering a lower price in exchange for high-volume purchases. Managing customer credit and collections. To maintain strong cash flow and good relationships with vendors, suppliers, and other business partners, companies must manage credit transactions carefully. When customers buy on credit, the amounts owed are tracked in the accounts receivable account, which appears as a current asset on the balance sheet. The terms of a company's accounts receivable policy can significantly influence how quickly cash is collected, but changes to those terms can also affect customer loyalty. Before tightening credit, owners should consult sales and frontline service staff, who understand customer expectations best. Even so, several key levers can be adjusted to speed up collections. The length of the credit period, the time allowed for customers to pay, can be shortened to improve cash flow, though this may frustrate some customers. If late payments are a consistent issue, the company can tighten its credit standards, raising the bar for who qualifies for credit. Offering early payment discounts is one of the most effective ways to accelerate cash collections, but the owner must accept a lower total cash amount from those sales. Charging interest on overdue accounts or applying periodic collection fees can also boost cash flow, though such measures may upset customers or reduce overall credit sales. Reducing bill payments. On the other side of receivables is accounts payable, the money the company owes to others. An accounts payable ratio shows how quickly the business pays its bills. This ratio is typically calculated by dividing the cost of goods sold, taken from the income statement, by the average accounts payable, taken from the balance sheet. Calculating bill payment turnover starts with the average accounts payable figure, found by adding last year's accounts payable total to the current year's total and dividing by 2. The accounts payable turnover ratio is then computed by dividing the cost of goods sold by this average accounts payable number. A higher turnover ratio suggests a shorter time between purchasing goods and paying for them, while a low ratio can signal a cash flow problem that may require adjustments elsewhere to ensure sufficient cash is on hand to meet obligations. The key is to watch whether this ratio gradually rises over time, which would usually indicate healthier cash flow and stronger credit standing with suppliers and lenders. Conclusion. Using financial statements for decision-making. External financial reports provide essential information to bankers, vendors, suppliers, and to people inside the business who do not have full access to detailed financial data. However, internal financial reports are the primary tools owners need to manage day-to-day finances and make well-informed decisions about the future of the business. By working closely with an accountant to develop customized internal reports, business owners can quickly identify problem areas and take corrective action. While there is an upfront investment of time and effort to design these reports, once they are integrated into a computerized accounting system, they can be generated automatically, providing ongoing value for many years.